All right, great. Why don't we jump in? Thanks everyone for joining us here. Last webinar of the summer. I guess we're already in September, but excited to present on our bridge financing platform today. We have a lot of exciting things going on in the transitional lending space, and we wanted to walk through a few important items today with our referral source community. Just a quick overview of the agenda. Going to give a brief company overview. Want to talk a little bit about our 3 different financing options for transitional assets. And then I'm going to have our head of credit, Alex Brombaum, walk through a few recently closed deals and talk about some of the more specific features of those transactions, how we structured those deals. They all were really great outcomes for the borrower. So excited to walk you through some real live deal examples. Talk a little bit about how to submit a transaction here at Liberty. And then our senior credit officer, Kevin O'Shea, who's also joined us on the call today, is going to walk us through really the requirements that we need in order to issue our CCL. And for those folks who are on the call in the referral source community, our CCL is very similar to a standard non-recourse loan application. We have 4 or 5 pages of terms, a credit questionnaire, all of that gets initialed and signed, receive a deposit, and then we're off to the races. And Kevin's going to walk you through a little bit more about how we package those transactions up front, required documents, and our underwriting process overall. So quick overview on Liberty SBF, founded in 2011. So we've been lending through 2 cycles. In total, we've closed over $2 billion in transactions. Very experienced capital markets focused shop. We have a senior management team that's been working together for over 10 years. And we take a very team approach here. We don't have commissioned originators. Everyone works on a bonus pool. You may be getting a call from a BDO on our team or originator on our team. All of our senior management has high levels of visibility on all of the transactions that are coming through the shop. And you've got a very strong and experienced management team here at Liberty. As a quick overview, we originate SBA loans, we originate bridge loans as well as conventional loans. And our sweet spot is really in the $1 to $15 million, $1 to $10 million bite size in terms of. So let's talk about our bridge platform. We really have 3 executions for transitional lending. So our first bridge loan product I want to walk through, we've titled the Heavy Lift Bridge. This is a loan product that starts at $2 million and goes up to $10 million, and really with pricing starting at $6.99 interest only. And I think for our referral sources on the call today, I think one of the more interesting things about this bridge product is that we're really focused on heavier duty business plans here. We can finance improvements and properties that have little or no in-place cash flow. We're comfortable offering up to 50% of the debt uses for CapEx and construction. And on those deals, we can go up to 75% LTC from a sizing standpoint. Again, going down to $2 million, up to $10 million on a per loan size. And eligible uses include purchase, rehab, and value add, obviously, but it's really more for heavy duty transitional type assets, and those are priced starting at 6.99%. So I think a very attractive pricing for smaller deals that have a lot of business plan associated with them, and we'll talk about a real live example of this type of deal that we've recently closed when Brombaum walks through some of those live deal examples. A really exciting loan offering that we recently launched, that we're very excited about it is our competitive smaller light lift bridge loans. And for our referral source community out there that's on the webinar today, these look very similar to your debt fund CLO type bridge executions. There's typically in-place cash flow, but these are getting priced at LIBOR plus 450 and up. So very competitive, non-recourse execution for deals that have a certain level of in-place cash flow And so this slide, we're really trying to help articulate what our minimum debt yields are by asset type. So for these transactions, a going in debt yield for multifamily that we're going to be looking for is 5%. We're going to need to see, a property that has some level of occupancy that's supporting a cash flow that provides our debt a minimum debt yield of 5%. Obviously, on asset types that are not multifamily, going from industrial up to hospitality, we're going to be looking for slightly higher going in debt yields. But these are very similar to what you're going to see on large loan executions that are going into the CLO market or that are being provided by debt funds for transactions on a non-recourse basis. Similar to the CLO market, we're able to go up to 80% LTC financing for multifamily and slightly lower for other asset types. And I would say typically we're looking to underwrite these deals to a 70 to 75% as stabilized LTV. And for hospitality, slightly lower, 65% as stabilized LTV. We're still underwriting these to a stabilized LTV that, will get the refinancing in that we need from the takeout financing perspective. The really exciting part about this platform, though, is that we're working on deals that are starting at 4 million, going up to 10 million. And I think there's a lot less competition and a lot less of an offering in that size range. We've been talking to a lot of our brokers in the referral source community. We're very excited about this loan product. Again, given the fact that it's got very similar pricing to the larger loan, non-recourse CLO type loans that are going off right now in the L450 to 550 range. But we're really focusing on that 4 million to 7.5 to 10 million per loan size, bite-sized loan market. And there's a real void in the market right now that we're looking to fill. Lastly, I want to talk about an option that you maybe don't always think about in terms of transitional, and that's SBA 504. And we have a strong expertise in SBA 504 financing. It's very different than what we're talking about today in terms of what we're doing and for investment real estate, for the first two bridge loan products that we talked about. But for anyone out there that's looking at hospitality, self-storage, or healthcare facilities deals, we are able to do those on a ground-up construction basis through the SBA 504 program. We're obviously going to be looking very heavily at sponsor, net worth, liquidity, and operating experience, having executed similar business plans in the past for those particular asset types. But this is an 85% of cost financing vehicle for ground-up construction, and we're able to put a lot of eligible costs into that total cost pie, including a lot of fees and closing costs. So it's a very high leverage, very low cost financing option. It is full recourse, but it is a very high leverage, low cost financing option for borrowers who are executing really heavy duty business plans and are eligible for SBA in the hospitality, self-storage, and healthcare industries. And the really nice thing about these loans is that it's the construction financing and it's the perm financing option. And when you wind up, the conversion from your construction financing to your perm financing occurs at C of O. So unlike traditional construction lending, where you are staying in your construction loan through lease up, your loan is converting to a fully fixed rate, long-term permanent financing vehicle as soon as you get C of O, at which point we file for the debenture funding, and you're getting that very low, right now, 2.88% fixed rate, fully amortizing for 25 years. So a very interesting transitional or heavy duty construction option for referral sources who have clients in the industry types that I just mentioned. I'm going to kick it over to Alex Prama. I'm going to talk about some recently closed deals. I think it's always helpful to talk about some real deal examples. So AP, take it away. Thanks.
Thanks, Alex. Before I get started, we got a question in from Cassava about the term of these loans and about prepayment penalties, which I'd just like to address now before we jump into examples. So all of these loans, really the first two bridge loans, SBA loans, a little bit unique, but the two bridge loan products, light lift and heavy lift, are both up to 3-year loans. They're bridge loans, they're short term, they're not permanent financing. In terms of prepayment penalty, there's not going to be a true prepayment penalty on either loan, but what you're going to have is some amount of minimum interest. You could have minimum interest as low as 6 months minimum interest on, say, a 1 year quicker business plan, but anything 2 years and beyond is going to have at least 12 months of minimum interest. We try to make the minimum interest match the tenor of the length of the business plan, so it shouldn't really cause any interest, any problem. But that is the answer to both of those questions, Kasaba. Thanks for asking. This is an example of a light lift bridge loan. This was a 75% loan to value, non-recourse loan to acquire a student housing property located near North Carolina A&T University. This was a loan where the property had cash flow going in. The occupancy was about 80%, so pretty close to stabilized. But the sponsors understood if they were able to raise occupancy above 90, they would have much better, permanent financing options with much better proceeds and be able to take advantage of the agency market. So this project was a very good example of a loan that came in with in-place cash flow, a little bit of a business plan that was expected to take about a year, took closer to 2, but not a very long-term business plan. It was only about a $5 million loan. So in the traditional CLO market, this would be much small. This would be, at the very much small end. Most CLO lenders, and I think that's the closest you can compare these light lift loans to, don't really want to go below $10 million. Some say they'll strategically go down to 5, but most really don't want to go below 10. So to do this at $5 million, we were able to provide the sponsor a very good loan, very good interest rate, good leverage, the flexibility to execute their business plan, and they were able to exit into the Freddie SBL market. One other thing about this loan is we were able to close it in under 40 days, start to finish, non-recourse loan, $5 million, 75% loan to value. So it was a really good execution for us. It was a good execution for them. They were able to execute their business plan. I think that it's pretty representative of the types of loans that we're going to do in this light lift program, some in-place cash flow, a business plan to execute, an underwritable, business plan. You're going to want to have your sponsors having experience executing this business plan, because we ultimately are often doing these non-recourse, and it's very important for the sponsors to have experience of bringing these. But anything in that bucket this is a really good fit. Just echoing what Alex Cohen said, I think a lot of the value of this program comes from the fact that this is a very established credit box and loan product that's been in the market for decades. What you usually haven't seen is lenders offering it, lenders offering it under $15 million, under $10 million. We're starting at $4 million. And so it can be a really nice fit for some of these smaller properties with good sponsors with, very defined business plans. This is an example of a heavy lift bridge loan. This was a 60% loan to value mortgage that we made on a multifamily property in Philadelphia to an experienced borrower there. The reason why it was more of a heavy lift as opposed to a light lift, there's some pretty significant cash CapEx that had to be performed on the property by the borrower. They had a combination of CapEx as well as fines to some of the local municipalities. In this case, the water department on some back bills. The combination of that was some pretty significant cash out and some time that it would take to complete the business plan. He had owned the property for quite a while, and it was a refinance, so he didn't require leverage the same way he would need on a acquisition. However, he did have a pretty decent business plan to execute that was projected to take a couple of years, which it did. We were able to come in, underwrite this loan. We have offices in Philadelphia, so it was local, and that helped. He had a very tight timeline. And we were able to close the loan in under 30 days. He was able to execute his business plan actually pretty quickly. And because of the low LTV nature and the flexibility with this loan product, we were able to do an upsizing on this loan a few months after the close of the loan. So the big difference, I would say, between this loan and the light lift loan was the fact that there is more of a business plan that he's executing. There was a combination of uses and a pretty decent amount of cash out that moved it into this bucket. He required flexibility and he required speed, and it made it a better fit for the heavy lift bridge loan. This was a $6 million loan. He was able to successfully execute all of his business plan and exit into an agency loan. So I would say any borrower that needs a fast execution, any borrower that needs increased flexibility, this is going to be a better loan than the light lift loan, especially in the case where there's not cash flow. This is a very specific example of refi with cash out. However, this can be a very good loan on an acquisition as well. Where we're seeing a lot of demand for this loan in acquisitions is loans with very little or no cash flow. We've done a number of loans where it's a good borrower and they're coming in, they have significant CapEx, they have little or no cash flow, and we're able to provide this loan for them because we're comfortable underwriting these markets and these business plans at the different leverage points of these loans. And it can be a very good fit for those situations. A loan amount starting at $2 million.
Yeah, and I would say that, most of the transaction that we're underwriting, there's also usually some other story that's associated with the prior management issues at the subject asset, but we get comfortable with the overall financial picture of the sponsor. We've been able to close these deals very quickly. So oftentimes, especially in today's competitive purchase and sale market, you just have a lot of demand for, quicker closes on these loans. We can close them in as little as 3 weeks. And I still think at a very competitive rate,
right? I mean,
relative to other, hard money options. Sorry, Alex.
Right. I mean, I was just going to say that, Alex. I think that, whereas the light lift loan I would compare to a CLO loan, this is much more comparable to a hard money loan. And to get hard money loans starting at 6.99 rates is a very good rate, especially with the flexibility of uses and business plans that this type of loan that can finance. So we found a lot of demand for this loan, and we think it's a great option for bridge borrowers. Lon, you want to go to the last slide? I'll go give a quick example of an SBA 504 construction. So this was not ground up construction, but it was a loan that we financed in Portland, Oregon, where a borrower was buying a condemned building, which used to be a nightclub and apartments, and they were converting it into, for as close as you could say for this type of property, Class A apartments. It was a complete gut. There's a seismic remediation being done. This project is almost done, but it's still in process. But they purchased the property for about $800,000, and then $1.3 million of the uses were for construction and construction-related costs. We were able to take those full uses and finance them, in this case, with an 85% loan to cost structure, in which we were able to finance the interest reserve, we were able to finance all of the different soft costs related to construction, all the hard costs related to construction, all the fees on the loan, all the third-party reports, so that pretty much every cost for the borrower in this transaction was rolled up into the total cost of the project. We financed it 85% loan to value. This was a borrower that's going to be owner occupied. They're occupying the full property in this case, but for a deal that fits this program, which is going to be owner occupied, or properties such as hotels, self-storage, healthcare properties, you're not going to get higher leverage construction financing anywhere. There's a lot of flexibility in terms of what's considered eligible uses. It's going to be the lowest capital requirement for this level project. And we really like doing this because we have a strong SBA practice, and it pretty much always ends up being a good deal for the borrower, just based on the amount that they have to put down to do a project like this relative to conventional financing. This borrower could not have done this project if not for the structure. It's, we hit some snags in the road because of COVID along the way, and even still we were able to work through all of it. They finished their project. It's beautiful. And it's really been a success story for both sides. And we're really proud of that. So we'd love to see these as well. It's a different bucket, but it's a very, very useful bucket for owner-occupied properties, construction. This is really as good of a product as you're going to get.
Thanks. Yeah, and just to back up what Alex P was saying, this is ground up construction or total adaptive reuse or heavy duty capex for build to suit warehouse and industrial. So, and logistics and widget manufacturers of all types that are doing ground up build to suit or heavy capex to existing structures. This is professional office. This particular deal was a professional corporation that was building out creative office space for the business. We have the ability to do ground up construction for hospitality, self-storage, and healthcare facilities, including skilled nursing, assisted living, and memory care. So definitely for those asset types, for more closely held businesses, this is a great construction option and something that, very proficient here at Liberty SPF.
All right, and that's it for deal examples. Al, I'm going to kick it.
So in terms of submitting a transaction, please submit that to Warren Rockra, who runs our originations team. His email address is vrockra@libertysbf.com. We are going to be sending out follow-up to this webinar with a PDF copy. So the submission process will be covered in that. But again, it's vrockra@libertysbf.com. As I mentioned earlier, it's a very collaborative process here at Liberty. All of our senior managers and executive management are on 2 pipeline calls a week. We have total visibility to all deals. We're actively working on all the transactions that come in the door. But Warren is a great point of contact and his team of originators to make sure that your deals get packaged quickly, that we're able to get you a quote on an as presented basis within 24 hours. We're very good at doing that. If that is a deal that makes sense for you, the referral source, and the borrower, we would like to then collect a complete package. Kevin O'Shea is going to walk through what that looks like. But with a full package, we can typically provide a CCL on a deal we're moving forward on within 48 hours. Obviously, speed and certainty of execution are very important. We try to do as much as we can upfront to screen and size the transaction and do it in a very quick way. Once you get your CCL signed and in the door, submit a deposit. We can close in as little as 3 weeks for our CLO light lift loan. It's not a CLO execution, but it's like the CLO market, but our light lift loan, that's typically going to be a 30 to 45 day close on a more conventional underwriting. I'll kick it over to Kevin O'Shea now, who can walk you through in a little bit more detail the documentation requirements for a submission package to receive a CCL. Thanks, Kevin.
Thanks, Alex. Hey, everyone. I'm Kevin O'Shea. I'm a senior underwriter here. Just want to add some more detail to that process in terms of Liberty receiving a loan application, taking it through underwriting, and to close. So, of course, that starts with application itself and required documents. Before I get into each checklist item, here at Liberty, we kind of evaluate a deal in 3 main areas on the bridge side. So number 1 is business plan. Can we wrap our heads around this business plan? Does it make sense? Is there a clear exit strategy? Number 2 is the property itself. So, asset type, location, as well as the property's performance. And finally, sponsorship. So sponsorship, financial strength in terms of net worth, liquidity, and experience, in this market and executing this business plan. So that really informs our upfront checklist we need to evaluate a loan. So to submit a package to Liberty, I'll go through these items, starting with transaction information. Obviously, if it's a purchase or refi, we'll need a purchase agreement or promissory note accordingly. Want some information on the business plan. Is this going to be a light lift, a short-term bridge, or more of a heavier lift, 2 to 3 year project? What does that timeline look like? And what is the exit strategy to get out of the bridge loan? If there's going to be CapEx, we'll want some more detail on that. So what's the total cost, the budget, and what does the timeline look like, the key hurdles that need to be cleared in order to complete the project? as well as some information on the GC that you plan to work with and their experience completing those types of projects. Moving on to property information, we'll get 3 years of property financials and year-to-date financials, see how the asset has performed over time. Is this a deal with in-place cash flow, or is it going to be a pro forma deal? If it's pro forma, we'll get 1 to 3 years of projections that sort of line up with that business plan narrative. And on top of all this, we'll get a rent roll, confirm occupancy as well. And finally, sponsorship information. We offer recourse and non-recourse loans here at Liberty. So as recourse, we'll collect personal tax returns to verify sources of outside income and amount of outside income. We'll get personal financial statements on the key sponsors, so confirming net worth and liquidity. And we'll also get a resume on the sponsor. So on these bridge loans, where there's always a business plan involved, we want to make sure that the sponsor is experienced in that market and has completed that type of business plan before. Once we get all these documents in a full application, our credit team can evaluate the loan in 48 hours and make a decision on if it's something we want to move forward with. If we do want to move forward, we're going to issue a CCL, which is a conditional commitment letter. Like Alice mentioned earlier, it's going to outline the terms of the loan and request an upfront deposit to order, our standard third-party reports. Once we get an executed CCL, we're going to order our third-party reports. We pretty much collected all the information we need on the credit sides to evaluate the loan. So it's really just getting the third-party reports and crossing our T's, dotting our I's. So those include appraisal, environmental report, and a property condition report. If there's CapEx, especially on a heavier lift project where it's not just replacing FF&E, but hard renovations to the building, we'll typically work with a third-party engineering firm, and we will order a document and cost review as well as a contractor evaluation just to make sure that the project makes sense from a dollar and timeline standpoint, and that the contractor is the right person to do the job. And for these longer-term construction plays, we'll hire that firm to do construction progress monitoring and draw control on a rolling basis. Once we get an executed CCL, like Alex said, we typically close our bridge loans in 30 to 45 days, but if there's a need for speed, we can, close in as little as 3 weeks.
Great, thanks, Kevin. And I just wanted to back up what Kevin said. We do have our own in-house servicing team, so we are doing draw request and monitoring in-house. If it's a heavy-duty CapEx deal or ground-up construction project, we will typically bring in a third party to assist with that and do some of the contractor evaluation. But just wanted to make that point. Before we head to questions, I just wanted to make a quick kind of announcement or a quick 1-minute commercial for an opportunity that recently has become available. And the reason I mention it is because we have so many in our referral source community who are on the call today. The SBA just made a major rule change, which now allows borrowers to refi from an existing SBA loan, typically a 7A, but also could be a 504, into a new 504 loan, which also can potentially allow the borrower to pull cash out. 7A loans are typically floating rate loans. A lot of borrowers in the hotel, self-storage, and healthcare industry use these loans to do development deals. Typically, they're higher leverage at start, but they're floating rate. Before the SBA allowed a 504 refi of a 7A, a borrower would use this high leverage loan, but they'd be stuck in the floating rate structure because they didn't have another non-subsidized high leverage option to refi into a fixed rate execution. Because 504 is also subsidized on leverage, you can now use this high leverage vehicle, which is a very low fixed rate. I believe the last month's print was 2.88% fixed, fully amortizing for 25 years, whereas most floating rate 7A loans are prime plus 2 3/4, so up to 6% floating today. You can do the refi of the existing debt. You can do up to 20% of the value of the property in eligible cash out uses. And one of the reasons why we mentioned this opportunity to borrow to our referral source community, is because we know that our brokers that we do business with also have a lot of relationships at 7(a) banks and have also helped borrowers acquire 7(a) or acquire properties using 7(a) loans. So two opportunities for this, what we believe is a $50 to $100 billion opportunity today, and it's rolling. So that's just what we believe is real estate SBA 7(a) debt that's outstanding, eligible for this program. If you have borrowers that you've helped get 7(a) loans before that are still in their 7(a) loans, they need to know about this program. It is a no-brainer, and we can pay referral fees typically between 1 and 1.5 points per transaction if we close the 504 refinancing on these deals. Second big opportunity for this, what we believe again is a $50 to $100 billion market. If you have relationships with local community banks who have 7(a)s on their books, most of the banks who originate 7(a)s, most of the economics are generated up front. They get paid fees for selling the guaranteed portion of the loan into the capital markets. Those are very hefty fees. Those are typically sold up front. And then the bank is left holding a residual loan that is not guaranteed by the government. Because that debt has, most community banks have a limited capital to do lots of 504 loans. They may have concentration limits in certain industries. They may have 7(a) loans. They would be fine getting off their books. We have the ability to be commercial in terms of paying fees out, sharing those fees between the referral source and the bank that's coming in to transact with us. We have 2 brokers right now that have brought us 8 to 10 opportunities on 2 banks that we're evaluating right now. So this is a bulk transaction opportunity, and it's something that we believe everyone should be thinking about. Obviously very different than our bridge product, but we have done some interesting things with our referral community over the last couple of years, whether that's big PPP volumes or looking at trade opportunities and refinance opportunities programmatically like this. We have a whole webinar that we did talking about this opportunity as well as some materials. Please feel free to contact us, contact Warren Rockra, our Director of Originations. My information is available on the website. Alex Brombaum's information is available on the website. We're happy to send you additional information on this opportunity as well. So just wanted to make that quick kind of commercial announcement. At this point, I'll kick it over to Alex Brombaum to go through any questions that have come in.
Okay, great. We have a number of questions. First question is from Steve Brunson. It looks like you have a transaction on a hotel. We'd love to talk to you about that. The best, it looks like based on the surface, it's a $5 million hotel loan, which would look like it could be a fit potentially for the light lift program, low LTV. But why don't you reach out to Warren Rockra is probably the best person to talk to about that but it looks like an opportunity that we would definitely take a look at.
Lon, can you throw the contact information slide up while we're going through the questions, and that way everyone can write down Warren's information? Sorry, on the submission slide.
The next question comes from Joe Briner. He asked, what will the index be when LIBOR goes away at year end? That's a great question. It's a question on a lot of people's minds, as most of the bridge lending, especially in the floating rate market, is done based off of LIBOR. Still some questions about that. I think everyone still is a little bit in wait and see mode. The number one candidate right now is SOFR, or secured overnight financing rate. It has got some quirks to it. I think they're trying to figure out if it can be the answer. But the way that we write all of our loan documents now is just have a market replacement that's not adverse in any way to the borrower, that can generate a comparable interest rate. So right now I'd say most likely SOFR, but we'll see. We will see. It's a good question though. Kala Spraberry asked, do you have anything for investors that are looking to pick up single family residential dwellings for hold or flip? Right now, we're not doing that financing. Our minimum loan size really on any of our product programs is about $2 million. Not to say there's not $2 million single family homes, but everything that we're doing through these programs is commercial. Does Liberty the last comes from an anonymous attendee, which says, does Liberty provide bridge loans less than $2 million? Right now, we're really sticking for the most part to that $2 million minimum. It's a hair below on the heavier lift. You can take a look at it, but I think 2 million is the number to look for on the heavy lift and 4 million on the light lift loans. And that is all of the questions that we have today. We appreciate everyone's attendance. We really look forward to working with everybody on these loan opportunities. We think we have, something for everyone, especially in this $2 to $15 million size range. And never be afraid to reach out and talk about a transaction. We love walking through deals. No bridge deal simple. So happy to do that. Look forward to working on transactions with everyone, and everyone have a great Labor Day weekend.
Thanks, everyone.